Hello and welcome. You're watching What's Hot. I'm Kritika Saxena. Let's go straight to the top story this evening. India now has the right to tax capital gains from Mauritius. The tax treaty between both nations have been amended in a landmark step to curb round-tripping and tax evasion. So here are the top 5 highlights of that amendment. 1. Capital gains tax from sale of share in resident Indian companies by Mauritius entities will be taxed from the 1st of April next year. Existing investors will not come under the tax net. Number 2. The government has announced the tax treaty with Mauritius will be amended along the lines of Mauritius. The move will avoid any tax arbitrage between Mauritius and Singapore. Number 3. The General Anti-Avoidance Rules or GAR will be amended to bring it in sync with the global tax treaties. Reacting on that very amendment of the tax pact with Mauritius, Revenue Secretary Hashmukh Adhia has tweeted, and I quote now, "The treaty amendment of DTAA with Mauritius brings about a certainty in taxation matters for foreign investors. It reinforces India's commitment to OECD BEPS initiatives of stopping double non-taxation enjoyed by many companies. Capital gains on shares for Singapore can also now become source-based due to direct linkage of Singapore DTAA clause with Mauritius DTEA." And that is exactly what Shaktikanta Das had to say to CNBC TV 18. We spoke to the Economic Affairs Secretary Shaktikanta Das a very short while ago, and he said the same tax could be levied on Singapore as well. Listen in to that very important clarification and him explaining how it will pan out.
With regard to Singapore and also Cyprus, the current double taxation avoidance agreement says that, it is linked to our renegotiation with Mauritius.
Okay.
So now that we have renegotiated with Mauritius and we have arrived at this revised agreement, so naturally to that effect, the Singapore agreement will also get modified. The amended protocol now creates a level playing field between domestic investors and the investors who had an unfair advantage when they came to the Mauritius route. It provides a grandfathering provision. There is a grandfathering provision for investments up to 1st April, that is up to 31st March 2017.
Yeah.
So all investments prior to 1st April 2017 are grandfathered. So it is not as if the market or the investors are taken by surprise. Sufficient advance notice is being given.
All right, so that's a very important clarification coming in from the Economic Affairs Secretary. But joining in to put this further into perspective is Senior Supreme Court lawyer Anuradha Dutt. Ms. Dutt, thanks so much for joining in. I want to clarify one very important point. The government has said that they will ensure smooth transition. You heard the salient features, but what really will be the key issues that may crop up as we try to put this into effect? Are there any loopholes that you see coming in while we look at the next 2 years?
Well, I can only say that this is a policy decision of the government of India. It has to weigh the investment that comes in, what will be the investor mood after this, and the tax that they want to, collect. So it's for government of India to balance, and it looks that they have now finally said that they would prefer tax coming in than, the investors getting this benefit of no tax through Mauritius. Also, it depends on the relationship between Mauritius and India because, India was an important factor for the development of Mauritius economy. So it looks, as I said, that the government has decided. I'm glad it's prospective and it's not retrospective. So to that extent, I think that's a good sign that they have given. And also between 17 and 19, what I read was that they are giving 50% off to those who invest for these 2 years also. So to that extent, if there is a clarity as of now, we have to actually see when the treaty is signed.
Yeah. Ma'am, the point is, anyway, as of April 2017...
It will affect.
Yeah, that's what I was coming to, Ms. Dutt. Anyway, from April 2017, GAR becomes applicable. Now, will the tax authorities impose this anti-avoidance rule and tax even those who get this 50% exemption? Is it not possible that you will see a lot of these guys who should normally be charged only 50% of the short-term capital gains being charged fully on the argument that you are in Mauritius only to avoid tax?
So I think that when they are putting the treaty in place and the amendments, what I'm hearing Mr. Das say was that they will ensure that GAR is in line with the amendments, and therefore there should be, a smooth transition, and it should not open up an avenue for tax officer again to, pick up a loophole. So I feel that the government has taken a positive step. At least it's made its intention clear, the policy clear. And I hope the law also now follows that clarity so that there is, at least people who now invest in India know going forward what is the clear law.
No, clearly the government's intent is above board. This had to happen. You cannot have tax havens and treaty shopping. That has become the rule in the world. But my point is, for an investor whom you may be advising, for a P-note investor or an FII or an FPI as they are now called, GAR ultimately is a matter of discretion of the tax authority. Easy going coming from Mauritius to avoid tax, or easy in the natural scheme of things, conveniently ensconced in Mauritius, or for that matter in Singapore. That becomes the discretion of the tax authority, doesn't it? And therefore, probably from April 2017 onwards itself, the guys investing from Singapore and Mauritius are likely to feel the heat of GAR, you think?
Well, as you correctly pointed out, the problem is that the intention is good, the law they bring out is good, but unless there is clarity in this, there will be some issues that the tax office is bound to raise. But I think, they're bringing the LOB, the limitation of benefit rule also. So I hope that, when they bring that in, there is a clarity to the investor, whether it's FII or FDI, as to where. I'm only hopeful that this clarity comes that this is where you have to pay tax. These are the circumstances you don't have to pay tax, so that they, arrange their affairs.
Ma'am, I don't know.
Although I disagree with you.
Do you have
Although
P-note
I
clients?
disagree with you that this is necessarily should have been brought in, because I think what the government has to do is to weigh whether they want foreign direct investment or, any foreign exchange coming in, or they want to collect tax. Okay. So it's a weighing, and that's going the other way, what they were doing earlier, where they wanted FDI, which they still want, which has not come in. I think giving tax exemptions is also not wrong or incorrect policy. Misuse by Indians is something they have to prevent.
That's the point, ma'am. I don't know. You may be having P-note clients, you think? P-note as a product dies?
Well, it's going to be a problem, definitely.
Okay.
It's good. And you also know that P-note has been now challenged in the Supreme Court. A public interest litigation has been filed yesterday, where Supreme Court of India has given notice. So I'm not sure in any way what is the future of P-notes.
All right. So in that case, a substantial amount of money that has come through P-notes either has to be regularized this is regular investment, but has to be reclassified as an FII investment, or they will have to be sold out and they would go. So a reaction on the markets is possible in the run-up to April 2017.
Absolutely. I agree with you, Lata.
All right. Thank you, Ms. Dutt, for joining us with your thoughts. So well-intended step, but markets will have its hiccups.
Okay. So